Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Manpreet and welcome to Cut to the Chase. Now it's a midweek lull, at least as far as financial markets are concerned, with even geopolitical worries in North Asia not causing at least an unusual level of volatility in global equities. However, while we await the key US labour market report at the end of the week, there were three developments across bond, currency and commodity markets that we found particularly noteworthy. Now the first was in bond yields. The broad market narrative in recent weeks has been one of cooling worries about inflation alone and rising worries about what Fed tightening could mean for US economic growth. This in turn resulted in long maturity US government bond yields trending lower towards 2.5% for the 10-year. Now, overnight, it seemed Fed policymakers sought to inject some caution into this narrative. San Francisco Fed President Daly said that the central bank was, quote, nowhere near done fighting inflation, while Chicago Fed President Evans said that while he thought a 50 basis point rate hike in September would be appropriate, he said that a 75 basis point hike could also be okay. Now, the result of these comments in bond markets was that the 10-year bond yield jumped to almost 2.75%, while the two-year bond yield, which is more like closely linked to actual Fed rates, rose a touch above 3%. Both of these, of course, following a modest repricing higher of the market's expectations of Fed rates by year-end. Now, on 10-year yields themselves, we have been of the view that a temporary move back higher was possible in the short term. However, in the bigger picture, we continue to see jumps in bond yields, like the one we just saw yesterday, as opportunities to add exposure to bonds. Economic growth remains a key concern, which puts downward pressure, particularly in longer maturity bond yields, and the 10-year yield appears caught in a short-term technical downtrend, even after last night's jump. More broadly, though, the rise in US government bond yields pushes yields higher across the dollar-denominated income asset space. Now, these remain at levels not seen in years, hence we see an attractive opportunity to add exposure to income assets, whether just to bonds or to multi-asset income assets more broadly. Now, second development was in currency markets. The dollar index rose alongside higher bond yields yesterday, causing the dollar-yen pair in particular to pull back. However, this follows what has been a remarkable multi-day downtrend in dollar-yen, which, as regular listeners will recall, is consistent with our view that any reversal in recent trends, in the face of a pause or peak in the US dollar, for example, would likely be most intense in dollar-yen because of how one-sided positioning has been in this pair. However, despite yesterday's breather, we believe technicals favor positioning for a broader move down towards about 126 to 127. Have a look, of course, at our daily FX Navigator publication if you want to read more about a short-term bearish dollar-yen trade idea, which kicked in at 132.5. Finally, a word on oil. OPEC Plus is scheduled to meet today and market expectations are lukewarm at best. OPEC Plus supply increases remain modest even during periods of significant upward pressure on oil prices, so any unusual efforts to raise supply seem unlikely when worries have instead shifted to that of economic recession and the related question of just how much that could impact demand for oil. Now, we retain a more balanced view. While weakening growth undoubtedly raises downside risk for demand, we note that policy efforts to improve growth and hence demand in China could help offset this to some degree. More broadly, oil supply continues to be at risk, with the lack of significant spare capacity risking a potential sharp rise should any events such as the ongoing Ukraine war cause any disruptions in a still very tightly balanced oil market. WTI oil is not far from key technical support levels, and long term we continue to expect oil prices to grind higher. So overall, opportunities to take advantage of higher yields and a potential trade idea, of course, in dollar-yen. But we'll take a pause there. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening and wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.